If you're looking to potentially grow your business or grow your investment portfolio, you really do need to have that future aspect in mind. It's never been more of an important time to make sure that you're getting your structures reviewed and set up with a really trusted advisor.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back on the podcast and back with a guest today.
Andrew. We are back with a guest. We're very lucky to have Ryan Finlay here from Willis Partners. Ryan, thanks for coming.
No problem, Billy and Andrew. Thanks for having me on. Long time listener, first time attendee, and it's just nice. So Ryan Finlay from Willis Partners, chartered accountants and advisors. Primarily look after our clients in the small and medium business entity space, and then also investor clients and high wealth family groups as well. But very excited to be on the show with you today.
No, awesome. Thanks, Ryan. I really appreciate it. And thought this would be a really fitting time to talk to people as well too, just in terms of what's happened re-tax changes from a federal budget perspective. So I know a lot of clients that we're talking to have got a lot of questions, and there's a lot of trepidation and nervousness around these days because one, there were some fairly significant changes, and two, we don't know where they're going to land yet because they haven't been legislated. But we wanted to unpack those and get your thoughts on probably a couple of the key areas. Andrew, what are those three that we're going to jump into?
Yeah, so today we'll talk a little bit around capital gains tax. Obviously, with the budget coming out recently, there's been some changes around that, what that is, what that looks like, and kind of some strategies that people can deploy or at least think about around what those changes are and how that impacts them. Negative gearing is another, obviously another massive change. And trusts, and I know that only a couple of days ago there were some changes and some carve-outs in the trust, but the impact from the tax side of things. And so I thought we'd bring out the most informed man in Australia. So here he is.
So Ryan, maybe over to you. Let's start with CGT. We'll talk about I guess what the proposed changes are, and then we can talk about a few different things in terms of the importance of keeping, records. What does it mean for business succession, and any other things that you think would be relevant to our listeners and our viewers about the CGT changes, because it's quite a dramatic shift from, I guess, what we're used to. And that system, the active asset 50% capital gains tax discount's been around for 20 odd years, and they're looking at changing it. Well, I'm being optimistic and saying they're looking at changing it. I think it's a foregone conclusion. But yeah, over to you. Let's rip into the CGT stuff first and see what all the fuss is about.
Yeah, very sounds great. It obviously was quite an explosive budget. I think some of the largest changes that we've had probably in almost 30 years since the introduction of GST, really. So they didn't hold too many punches in all of these changes, but obviously one of the major ones that you touched on was the changes to CGT, replacing the 50% discount with indexation. So a massive change for investors, business owners alike. A lot to unpack there for people with their planning moving forward, given that there's also a minimum 30% tax that's going to apply to CGT as well. So you're sort of getting hit on multiple fronts. One of those obviously being that the 50% discount is being scrapped. So that's going to impact a lot of investors, but you're also having the minimum 30% tax being applied on what's the new capital gain calculation. Yeah.
And so I think, an important thing to note, and maybe a question for you is, for someone that's been holding an asset previously, what are some of the important considerations that you need to have if you're an investor and you've been holding an asset under the old rules, and now that there's a bit of a shift in some of the legislation and some of the tax methodology, what are people that are already holding assets needing to do?
Yeah, so I guess an important factor to note is the it will be grandfathered, and that is what the government is already stipulating. The legislation obviously isn't out yet, but there will be grandfathering. So you don't need to be super proactive or have a massive knee-jerk reaction to this legislation. My advice is still to obviously speak to your advisors and don't just go and sell the whole portfolio right now, because there will be grandfathering. So though those changes are coming in for assets acquired after the 1st of July 2027, the assets that you do hold at the moment and you hold them post that date, you'll still get the 50% discount up to the market value at that point in time. So I'm sure that a lot of your clients will be speaking with you a lot around what the market values are for the assets that they hold at that date. But effectively what will happen for disposals post that time is you'll almost have two CGT events. So you'll have one based on the indexation that's applied to the market value of the asset post the 1st of July, but you'll also have a separate capital gain, which effectively looks at the original cost base and then the market value at 30 June 27, which you do get a 50% CGT discount for that portion. So it's a bit for accountants as advisors in it. We have a lot of CGT calculations to work through, but for your mum and dad who probably likes to have a clearer understanding and position of where they're at, it becomes quite complex.
Yeah, I mean, look, complexity is good for us. It allows us to sink our teeth into certain things and obviously demonstrates a lot of value for people. But the old system, call it the old system was just simple. Everybody sort of understood it and knows how it works, whereas this gets a little bit more complicated. Just a question about the 30% minimum CGT. So I understand that we're talking about sort of two regimes, and you have your old method, 50%, and then you've got your new method with the indexation, and you're kind of doing sort of two calculations when you dispose of an asset. So that makes sense. But the 30% minimum CGT, do we know yet? I'm assuming that it's on the new portion from when the indexation method kicks in.
Yeah. That's correct. Is that right? That's what we're being told. But again, it's a difficult field to navigate and advise on because that legislation isn't out yet. See, you can't be 100% clear on whether that 30% is going to fly to what they call the old portion of the capital gain, or if it's going to apply to all of the disposal from 1 July 2027. Yeah.
And I think it really hits investors from both sides, because on one hand, you're incentivized to hold an asset for long term because you're not getting that 50% discount right away. But then on the other hand, investors that have been holding assets for long term have typically held an asset for a long period of time in order to be able to time the CGT event. So selling an asset where they're in a zero income year.
Yeah.
And so you overlay that minimum 30% on, and it just really seems like the government is trying to cut every single loophole. You have to make sure that they're getting their clip of the ticket along the way, regardless of what the investor does.
Yeah, for sure. It's very difficult for clients that you might have who are, say, planning for retirement. They might be sitting on a share portfolio or something of that nature that they're looking to carry that through to post their retirement, but maybe liquidate some of those assets in their retirement phase to take advantage of the lower income tax rates. Obviously, that's hamstrung given that you're going to incur 30% tax on that capital gain at a minimum. So you're not being able to work through the lower tax brackets with it. You've got the income tax-free threshold and also your 19 and 30% tax brackets.
Nice tax grab by the government. And that's actually a good conduit into, I guess, the positioning of all of this was to really help the next generation get into the housing market and make housing more affordable. But while we're still on CGT, we're not actually just talking about capital gains tax on property. This is applying to all asset classes right across the board. So you could have a business owner that has a business and has had it for 30, 40 years and is planning on that being their nest egg or their retirement. Obviously that changes. You might be talking about a new investor or a younger Australian who's looking at saving through or investing through a share portfolio. in order to save up that deposit that they're talking about. But this is right across the board, yeah?
For sure. Yeah. So it applies obviously to shares and other investments, not just strictly property. If I had a crystal ball 6 months ago, I would have thought if they were making these changes, they would apply them just to residential property. It obviously impacts the Australian investment market, in my opinion. You might not want to get investors from other countries wanting to come and do business as much here in Australia with these changes. And that's obviously not trying to get too political, but I think that is the snowball effect of what you will see.
We love a bit of a rib up on the government, so feel free. You're in good company with that. And I heard the saying when was it? Yesterday I was listening to something, but common sense isn't that common. So that goes to explain that.
Yeah, and look, I think that there's what we've already seen to some degree is I don't know whether it's a reversal in position, but you have seen the government buffering under some pressure. At least that's my opinion, sort of, the reason behind it. But they have done some carve out. One, which we'll talk a little bit around trusts and discretionary trusts that happen in testamentary trusts. But also when it comes to capital gains tax, there were some changes recently that they're saying around the small business and what qualifies as a small business for some of the concessions. Is that right as well?
Yeah, that's right. So obviously the ripple effects through the Australian public has been very significant. So a lot of backlash that the government is copying around these proposals. And we're only 36 days, I think, post-budget. And there's already been a bit of crippling of some of these legislative pieces, if you like. So I know you're correcting that there's been a development in the small business concessions. So one of the key four qualifying characteristics, if you like, of being eligible for small business CGT concessions was that your turnover was less than $2 million. It's probably the most common eligibility threshold. There are four other ones, as I mentioned, but they're extending that out to $10 million. So if you're a small business that's turning over less than $2 million, previously that would have made you eligible for these concessions. And now if you're a small business that's turning over less than $10 million, you'll become eligible for the CGT concessions. But in my opinion, again, a lot of that 10 million versus the 2 million, it probably doesn't open the door actually to as many small businesses as what they think. A lot of those businesses would currently be eligible regardless under the minimum 6 million net asset value. So as much as the government is coming out and saying, look at what we're doing here for small business, we're extending it from 2 to 10, I think that a lot of these small businesses would have been eligible under the $2 million turnover. Anyway, Sandra, but it's just politics then. They're just trying to sell another story to buy a few more votes.
Sounds like it's smoke and mirrors like usual. But look, let's talk about the national sport of ours, so property investing. So the big one that's making a lot of noise is the changes to negative gearing. Obviously, a lot of Australians, try and grow their wealth by acquiring an investment property, and they have one and they claim the negative gearing because that helps them to service the debt and be able to become, a landlord essentially. That's obviously changed. That's a really big one. Can we go through those changes, what that is, and what we think the impact's going to be on, I guess, the investment market more broadly, and what does it mean for people who are investors? And then maybe we can talk a little bit about if you're a tenant and you're renting, what the expectation is, because this isn't the first time that this has happened in Australia. We've seen this story before.
Yeah, for sure. So with regards to the negative gearing reform, previously, if you had investment property that after you factored in your interest deductions, your depreciation on the property, council rates, all of the other expenses that you incur in holding that property and renting it out, you could offset that loss against your other taxable income. So if you're mum and dad, you had an investment property, you might be on wages. If you had a loss on that rental property profit for the year, you could offset that against your other taxable income, which is your wages. And so that may lead to a refund that you would get back in your pocket to help you offset some of the expenses in holding the property, or reinvest that to hopefully purchase another one in the future, whatever your strategy may be. What we're looking at now from effectively from budget night is that any properties acquired after that date, if you had a loss on your rental profit or loss for the year, that actually gets carried forward. You don't get to offset it against your other taxable income. It will be carried forward to the point that you either have a profit, or if you dispose of the property, it will actually get input into your cost base instead. So it'll impact your CGT calculation, obviously, at that point. So that's the primary changes. It is to established residential property only. So new builds won't be targeted by this reform. They'll still be able to offset the loss. So I guess that's an interesting one for discussion points for Andrew and Billy in the... I wasn't to be asking the question. Hey, sorry, you asked. Do you think that you'll see a lot of your clients looking to invest in new builds rather than established property?
Look, without giving investment advice, I think, there's two trains of thought associated with this. I mean, one, you've got an income play, and the other one, you've got capital growth. And traditionally with a negatively geared property, what you are looking for is, you take the loss as you go from a cash flow perspective, with the understanding that at some particular point in time, you're going to be able to recoup those costs plus a lot more with the capital value that you extract once you sell a property. Now, if we look at new builds, traditionally, you're probably talking where there's a fair bit of vacant land. And then if there's a lot of vacant land, then you look at it and go, okay, what does it then do from a capital appreciation perspective? And does that then stack up from an investment point of view? So I'm a little bit conflicted in what that will look like. My personal opinion has always been that I don't love, going into that type of asset, because there's a lot of, it can be a lot of supply. And then what does that then happen to sort of growth and capital appreciation? So it's going to be an interesting one to see. And I think, just adding some sort of more salt and pepper to it, I'm quite concerned about what this looks like from a property spruiker perspective. And I think a lot of people are going to get duped into purchasing an asset that looks great on paper when you're looking at, certain projections and tables and glossy brochures, but they end up being, not worth as much as what the investor would have thought of. So, yeah.
And I mean, the other thing to consider as well, when you are thinking about this from an investment perspective, I mean, one, in any investment decision, the tax shouldn't be the primary motivator for investment. Like, it really needs to be around, what is this doing for me, and how is this actually growing my wealth, as opposed to a tax play. Tax play is a benefit, but it's not the primary motivator. When you start to consider the type of person, and exactly what you're saying, Bills, where you're looking at a negatively geared property, what you're trying to do is claim a tax loss in order to be able to get a investment gain in capital growth. Well, the moment that you've purchased that property, it's no longer a brand new build. So to the next person that's purchasing it, all of a sudden, you don't get those negative gearing benefits. So if anything, that's a detractor from capital growth, because you're now, the pool of investors that you can sell that property to is less. So if anything, and yes, you need to consider the specific property that you're looking at, the land component around it, and all of the specifics to make an informed decision. But further to your point, Bill, I'm very concerned around the impact that this is going to have to the property spookers, because your standard mum and dad investor isn't necessarily looking at this level of detail most of the time, and they're relying on the information that they're getting, when they're making that purchase. And so it may actually be a further detractor as opposed to something that is of benefits. I'd definitely be proceeding with caution if that was the direction that I was taking.
Yeah, and probably a call out with this too, which benefits us, is if you're faced with that, you're going to need to lean into your trusted advisor, your accountants, your financial advisors. And I think that relationship in this instance, and for that type of transaction, becomes even more important, simply because there are going to be people out there that are going to be looking to take advantage of people. So that's an unintended consequence of what this thing looks like. Ryan, maybe let's cast our mind to what impact we think it's going to have on rents for people who are renting. So if they're on the other side of the equation, because when we look at the numbers that the government have produced and what they're saying that Treasury have forecast and stuff, I mean, I look at that and I think it's a load of BS, right? So I don't know if it's just me being cynical as I'm getting older in my old age. But yeah, over to you. Are you hearing sort of similar stuff in your circles as well too?
Well, obviously, I look at the numbers and what the flow-on effect of those is. So I think if you have the investor who now is having less cash in their pocket due to the fact that they might not be able to offset that loss against their taxable income and get that refund benefit, they're going to have to try and recoup that loss in some other form if they want to hold on to the property. And what's the primary way that they can generate more income from that asset is obviously to increase the rents. So I feel that is what will ultimately happen, and that's obviously going to be at the detriment of the renter, who may also be someone that is targeted by these changes by the government. I mean, they're saying that we're trying to help you get into the housing market. They might actually have more expensive rents to be dealing with, which impacts their ability to save, and it may prolong them actually getting into the market.
Yeah, it's quite interesting. We have seen this before. So Paul Keating did it when Bob Hawke was Prime Minister in the 80s. That lasted 2 years, I think, looking back at the record books before that got unwound. Our mates across the ditch in New Zealand did the same thing as well too, and that lasted 2 years as well too. So let's timestamp it. It's 2026. It came in 2026. Let's wait and see. 2028 is where it's at.
Let's see which government is more started.
Well, let's see what government's in a couple of years' time. So,
look, in terms of structures, does it change your thinking around when you are purchasing, in particular, a property because of that needed gearing? You know, traditionally you kind of have your trustee company and individual. Did it change some of the full process around how people hold assets and in what structure?
Yeah, for sure. I think you'll see a lot of individuals and even your mums and dads, investors, potentially looking at holding property in particular, and shares and investments as well, given there's widespread. I think you'll see them holding these investments in other vehicles, such as companies, probably primarily, where if you look at the past, because the company wasn't eligible for the 50% CGT discounts, that was the main driver for not having it held within that sort of investment structure. But I think now you'll see a lot more investment within a company vehicle to take advantage of the company tax rates, and people trying to use that as an investment vehicle to continue to grow their wealth within that company structure, as opposed to in the individual format to utilize the loss benefits.
Absolutely. Now, Andrew, we were talking about the changes to trusts and testamentary trusts that we were talking about. So let's jump into that, because that one really was a huge concern for a lot of families, especially when they're thinking about what does it look like from an intergenerational planning perspective. And really, a lot of people were calling this a death tax by disguise. So what does it look like? And yeah, let's talk about the carve-out that we've seen happen over the last couple of days.
Well, I mean, look, the biggest news is that in the last couple of days, there has been a carve-out for your testamentary trust where the minimum 30% of distributions, provided that a testamentary trust is set up for genuine testamentary reasons, there is the ability to distribute without having that minimum 30%. Look, take us through it, Ryan. What was the change to trusts in particular? And yeah, I mean, fortunately, there's been that change to the testamentary side of things, because I know that was a huge concern, especially amongst the lawyers, the wills and estates lawyers, where you've set up these structures for a particular reason, and all of a sudden that's, been, well, was at least blown apart with the budget announcement.
Yeah, for sure. So the primary change was including a minimum of 30% tax on discretionary trust distributions. So where previously you might have had a discretionary trust that you would distribute the income out to, say, mum and dad, potentially adult children or minors, and you'd be able to utilise their marginal tax rates. Now the tax will be applied at 30% to the trust itself. That individual will then receive the credit, if you like, the tax credit for that 30%. So almost like a franking credit. Kind of. However, a franking credit is refundable, where the 30% tax is non-refundable. So on that distribution, you'll be required to pay a minimum 30% tax. So it's obviously being brought in to really try and stamp out the distributions that individuals can take advantage of their lower marginal tax rates. And as you touched on, it was to apply to discretionary trusts, but also to testamentary trusts as well. And so, as you said, a lot of lawyers and advisors in the wills and estates planning space were very up in arms in that the idea of the testamentary trust is obviously there to provide a benefit to your children with savings and estate planning that you've done over a long journey. So to then apply a 30% tax on distributions that would be going out to minors primarily on the earnings of those trusts until they're at adult age and they can withdraw those benefits, it probably seems a bit harsh and a bit unfair. So that is something that there's been a carve-out applied for that, which is a good result in that space. We'll see if there's any further carve-outs for the small business environment, if you like, for trusts that are currently utilising a discretionary trust structure. But what they have said, even at budget night, is that there will be restructure or rollover relief where enterprises that are set up running out of discretionary trusts will be able to change that to a different vehicle that won't incur the 30% tax on the trust earnings. So an opportunity there to restructure to, say, a company, and you're incurring the 25% marginal tax rate, or a unit trust structure instead. So I think you'll have a lot of advisors, accountants, lawyers working through restructures for their clients over really the next 3 years.
Yeah. And with a lot of the trusts, and once again, you're sort of asking for clarification on this, and maybe we know, maybe we don't, but there was from what I understood, it was the discretionary trusts that seemed to be the issue that the government wanted to target. And that obviously makes sense, whether it's fair, whether it's un-Australian, we can debate that after we turn the cameras off. It's called the money grab. What it is, a money grab disguised as trying to give more opportunity to a younger generation, while it's, taking away all of the rules and benefits. Anyway, sorry, let's call a spade, yeah, for sure. So discretionary trusts, obviously that's the one that they're trying to hit up. But there was also some commentary around if you're in a fixed trust, then those rules don't apply. Was that correct, or have I misinterpreted that?
That's correct. So if you're in a fixed trust or a unit trust, these provisions won't apply to you. I guess that the primary aim here, what they're doing, is targeting that discretionary element, where probably the most common scenario is you do have, say, a family group, mum and dad, and you've got probably your primary business, which is in a company structure. You may have a dividend or profits coming up from the company to the discretionary trust. Now, you might have either the mother or the father who may not be working or earning income in that particular financial year. So when you then distribute that income from the discretionary trust, you'd be silly if you weren't distributing it to the lower income earner and taking advantage of those lower marginal tax rates. That 30% has obviously been brought in to effectively remove those lower marginal tax rates. But in the scenario where it was a fixed or a unit trust, you don't have that discretion in the first place. And as the name implies, where those distributions are going are fixed. Yeah, so they're taking away that discretionary element where you can target lower marginal tax rates.
Yeah, it's quite an interesting one. I often think about this and go, okay, once again, I understand the intent, which is, hey, how do we get more revenue? Because we can't control our spending, so that kind of makes sense. But when you think about it from a business owner's perspective, and you go, okay, and this structure is quite typical amongst sort of small businesses in Australia, but you think, okay, there has to be some benefit. You might have one member of the household working, and then the other one that's staying at home and doing what have you, house duties or raising the children, it could be. But I always thought that the system should encourage and reward people for taking risk to start and grow a business and employ people and contribute to the economy. So once again, coming back to that un-Australian part, don't know how that lands, whether or not we see some of that winding back. We'll wait and see, but don't seem to see too much about that in the media. But yeah, that one's definitely going to hurt. And good to see that from a testamentary trust perspective, at least they're not introducing that death tax, so to speak, for the children, because I think that one was just totally undigestible by the Australian population, that's for sure.
And I think that, maybe one final thing when we're talking about trusts, what's kind of blown apart as a result of all of this is your bucket companies and your trust structure to then distribute into a company. Do you want to talk us through a little bit around that, around sort of what some people would do from a tax side of things to delay a tax obligation and how it's kind of just killed people that were utilizing that strategy? Yeah, for sure. So previously the use of a bucket company, I think you said it well there, Andrew, is that it's more of a tax deferral mechanism. So again, using that scenario that we had before, we have a company that the shares are held by a discretionary trust, and then we have a separate company, which is a corporate beneficiary or a bucket company. Rather than having that dividend be distributed out to the adult beneficiaries of the family group, if they don't need to use those funds right now, they may look to distribute those to a bucket company and use that to invest. And the ideal part of that strategy is that if it was, say, raising a franked dividend from the trading company, goes by the family trust with a franking credit of 25%, distributes to your bucket company, which the tax rate is 30%. So you've got a 5% pretty minor top-up tax that you're paying in the company. And then you can use those proceeds within the corporate beneficiary to go and invest and generate wealth in its own right and pay tax at the corporate tax rate of 30%. What this legislation does now is that, again, you raise the dividend from the trading company to the discretionary trust. It comes with a 25% franking credit. When you then distribute to the bucket company, the bucket company doesn't actually receive any credit or benefit from the 30% tax that the discretionary trust has paid. So say that it was $100 of a dividend that was flowing through from the trading company, and that's including the franking credit. So $75 worth of profits, if you like, goes up to the discretionary trust. The discretionary trust has $100 of taxable income. When you then look to distribute that to the buffet company, 30% tax is withheld within the trust. So you're left with $70. The $70 is what then flows through to the bucket company. And that corporate beneficiary doesn't get a credit for the 30% of tax that's being withheld in a double cut. It's a double tax. So it there pays 30% tax on the $70 with no recognition of any franking credit that has flowed through from either the trading company or the discretionary trust itself. So it is trying to kill the bucket company. So bucket companies got holes in it everywhere.
It's no longer a bucket.
Exactly right. Look, I think that what this really highlights and what all of this, really means it to the individual investor, to companies, to family units is really the need for advice. And I think that, there's never been a greater time now. And the old or the old adage of, you buy one asset, you hold it long term, you get a 50% discount on the capital gain, then maybe you retire on, some age pension, just doesn't really hold true anymore. And I think that when you've got a more complex environment, when you've got a more complex tax structure, and ultimately, things are, more complex to, add complex, into it, the need for advice and the need for trusted partners is hugely important. So whether it's, financial advice, and when you are looking at, what your options are for, growing your wealth, then, I think that there's a real need for that. But also from the tax side of things, when you overlay some of the complexity that's also come into it, having someone such as yourself and the team at Willis Partners, I think is hugely important.
Yeah, for sure. I think the Australian tax system, when you're looking at setting up corporate structures or different entities, was already quite complex. But now for your everyday investor or your everyday business operator, it has that extra layer of complexity now that you really should be speaking to a trusted advisor and confirming that you are in the right structure that's not only going to benefit you right now, but into the future. If you're looking to potentially grow your business or grow your investment portfolio, you really do need to have that future aspect in mind. So it's never been more of an important time to make sure that you're getting your structures reviewed and set up with a really trusted advisor.
We advocate for it each and every week where we talk about getting advice, but good to hear that that's becoming a greater and greater need for a lot of people, so they don't make mistakes. Ryan, what we'll do, we'll also have your details in the show notes as well too, for you and the team at Willis Partners, in case anybody wants to reach out. But just wanted to say thank you for today. Really enjoyed that session.
Always good to have some more brains and some better looks on the podcast. So thanks a lot for coming along. Bills, thanks for another great podcast. And to our viewers and our listeners, I hope you got some value out of that one. As always, Billy and myself, our details are in the show notes, but we've also got Ryan's details in the show notes as well if you do need anything from a tax and accounting side of things. If you did get some value out of that, like, subscribe, and we look forward to catching you on the next podcast. Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of Acumen Financial Planning Proprietary Limited.